This is your 15th program in the series on the principles of accounting. Management requires periodic reports as a basis for ongoing evaluation of operations and for special measures if necessary. Some reports like cash, sales, and certain inventory are required daily, weekly, and monthly. But for external purposes as well as internal, a full and complete set of reports is required at least once a year. Most government and credit agencies ask for year-end reports plus significant interim reports, but they will accept reports for fiscal years which end at any convenient time of the year for the organization. If accounts are kept in good order, if posting is kept reasonably current, and if the basis for closing adjustments is well understood, it is not difficult to assemble these figures so that year-end statements can be prepared. Unless a computer system is used, a worksheet is prepared to assemble and present the data which will be used for the year-end reports. A 10 or 12 column worksheet is useful. What reports will be finally generated by this process? Yes. We will assume first that the trial balances of all the accounts in the various general and subsidiary ledgers were taken and balanced, with all the steps required to correct any errors. The worksheet is then set up with firm name, title, period, and date. Headings are written for each of the 5 or 6 pairs of columns, including debit and credit columns for trial balance, adjustments, adjusted trial balance, income statement, and balance sheet. All of the account titles and numbers in the chart of accounts are listed on the worksheet, even if they have no balance, since they may require an adjustment. Some accounts, like cost of goods sold, should be allowed more than one line to provide space for several entries. The typical column pair headings for the year-end worksheet. Right. The reason for multiple entries in the cost of goods sold amount columns is to collect the amounts of beginning and ending inventories and purchases, net of discounts and returns. Why would you write an account on the worksheet if it had no balance? Certain accounts normally require no adjustments and will appear in the trial balance, adjusted trial balance, and balance sheet columns. Typically, these are cash, including bank accounts and petty cash, equipment, investments, if any, notes and accounts receivable, and the accounts, notes, and various taxes payable. Some of the asset accounts usually require adjustments at the year end. One is inventory. The beginning inventory is shown as a debit or positive amount on the account, and therefore on the trial balance debit column, but this is removed or offset by an entry in the adjustments credit column. The ending inventory is entered in the adjustments debit column. These two adjustments in reverse or their difference is later entered in what other account in the adjustments column. The principal liability account, such as accounts payable, notes payable, salaries, and taxes payable, will not usually require year-end adjustments if they're current and posted. Other liability accounts, such as accrued interest payable, will require ending adjustments. In the same respect, the various depreciation accounts, which are not liabilities but contra-asset accounts, will also receive ending adjustments. What would be typical of such adjustments? Right. In compiling the elements of the cost of goods sold, the amounts of beginning and ending inventories are entered in this account in the adjustments column as offsetting entries to the adjustment column entries in inventory. In addition, adjustments are made by crediting net purchases and debiting cost of goods sold. In some cases, net purchases are obtained by additional entries in purchases returns and purchases discounts. On the year-end summary worksheet or the equivalent computer printout, the first pair of columns are the trial balance, the account balances from the ledger. The second pair are adjustments, and the third pair, the adjusted trial balance. Which accounts are typically affected by year-end adjustments? Yes. Of course, the cost of goods sold account, like the various expense accounts, is a temporary equity account which does not appear in the balance sheets. But you will recall that, unlike the expenses, it does not have a balance in the original trial balance, since it is first entered in the adjustments columns, then also appears in the adjusted trial balance and the income statement columns. The overall or summary worksheet is often supported by subsidiary worksheets, sometimes related to subsidiary ledgers. For example, operating expenses may be entered in 3 columns of a single line on the overall worksheet as the totals of columns in a special operating expenses worksheet. What are some accounts you would expect to find on such a special worksheet? Yes. And of course, telephone and other utilities, taxes, and miscellaneous expenses. The foregoing would be entered in the trial balance debit column of this subsidiary operating expense worksheet, while the adjustments column may have entries from insurance, depreciation, and supplies expenses, which require period-ending calculations. You may notice that the operating expense worksheet contains only the debit balance columns. Why is this? Right. You will recall that in many accrual systems, supplies such as advertising catalogs, office supplies, and postage are recorded as assets when purchased, and at year-end, the value of the balance on hand is subtracted to obtain the cost of supplies which were used. This is entered as supplies expense in the adjustments column of the operating expense worksheet. In a somewhat similar way, prepaid insurance premiums are entered as an asset, in this case, prepaid expense. Then at the end of the year, a proportional charge is made to insurance expense and a reduction in prepaid expense. If an insurance policy were purchased with a 1-year premium payment of $500 on June 30th, what entries would be made on December 31st? Yes. At the end of the year is an appropriate time for writing off bad debts and writing down the value of inventory. If there is a contra-asset account to accounts receivable called allowance for bad debts, in which some selected percentage of credit sales are entered, this may be then applied to specific bad receivables. The operating expenses worksheet, since it has only debit columns, cannot be checked by ordinary balancing, but a simple check can be made by adding the first 2 columns, the trial balance and the adjustments, and checking their total with the last column, adjusted trial balance total. Then where are these totals transferred? Right. When a total amount such as the operating expenses is brought to the summary worksheet as an adjustments debit only, there are, of course, offsetting credits and adjustments, mainly to asset accounts such as supplies, prepaid insurance, and accumulated depreciation. amounts in the original trial balance have been previously balanced. On the summary worksheet, the next pair of columns, the adjustments must now be balanced and any errors corrected. The third set of columns, the adjusted trial balance, naturally derives from the first two, and any errors which occur are merely the result of copying, omissions, or reversals, and can be detected by balancing the totals. At this point, it should be noted that if a computer or accounting machine is used, the sort of errors which occur in hand-copied accounts do not occur. But similar worksheet printouts may be obtained for study, so knowledge of the traditional processes is useful. What are the last two headings of the summary worksheet? Yes. As soon as the appropriate amounts have been brought over to the respective income statement and balance sheet columns from the adjusted trial balance, the total debits in the income statement plus the balance sheet debits should of course equal the adjusted trial balance debits, where they came from, and likewise the credits. The totals of debits and credits in each pair of statement columns will probably not balance, but their difference should be the same. The difference is net income, a profit or loss for the period. Now enter this amount to balance the statement columns. Certain of the special year-end entries are, as you know, called adjusting and closing entries. Those entries which are called closing do in fact close out all of the balance in certain accounts, including purchases, freight, purchases, returns, and the operating expense accounts. When these adjustments are made, original entries to record and explain them are made. How do you think this is done? Yes. This is called journalizing the adjusting entries. This is, of course, different from the usual procedure of posting ordinary transactions from the journal to the ledger, so the posting checks are made at the time of journal entry. These entries and the other year-end closing accounting work are made days or weeks after the year-end. But how are they dated if the fiscal year is the same as the calendar year? Right. There are several ways to make closing journal entries, but all of them result in reducing temporary equity accounts to zero and raising or lowering the permanent equity accounts to reflect profit or loss in the period which is ended. The permanent equity account is capital, including, if a corporation, retained earning or loss. What are some of the temporary equity accounts which are closed out by year-end adjustments? Yes. Some accounting systems include a profit and loss or income summary account to combine most of the temporary equity accounts such as revenues and expenses. In the year-end closing journal entries, the income summary is debited and capital is credited with any profits which were earned during the period. Some firms may, at the end of a year, distribute some of the year's earnings, if any, to the shareholders, partners, or in the case of a proprietorship, to the owner. This is not always a closing or year-end activity, however. The payment of part of the retained earnings of a corporation to shareholders is called a dividend. Corporate retained earnings are earnings left over after state and federal income taxes of nearly half of income have been paid. Shareholders then must also pay personal income tax on these previously taxed earnings. What would you call the payments from earnings to partners and proprietors? Whether owner, partner, or shareholder payments are made or not, the closing entries finally result in a new permanent capital amount. When the entries are written into the journal, the sales or revenue accounts are closed first. Here you see in the journal, under closing entries, entries for sales, interest earned, and other income. The closing entry from the expense and revenue summary may break sales down by departments or major products lines, or list merchandise and services separately, as well as showing sales returns and discounts separately, instead of merely a single entry for net sales. After revenues, entries for expenses, usually from the expense and revenue summary, are entered into the journal. When entered in limited detail, the cost of goods sold will usually show the largest amount. After revenues and expenses, what closing journal entries would be made? Right. In order to indicate clearly on the expense and revenue ledger accounts where 1 year or other period ends and the new year begins, lines are drawn below the lowest entry, whether debit or credit, and the total of debits or credits written. The closing entry brings these accounts to zero balance. Then heavy double lines are drawn below the totals. This is called balancing and ruling. In addition to the temporary equity accounts for revenues and expenses, permanent accounts may also be lined to mark off the end of the fiscal year. What is this process called? In addition to yearly closing and completed reports, similar but less elaborate procedures are employed to provide current information on operations and condition. Such reports are called interim reports. The process of recording, then adjusting, closing, documenting, and reporting the financial data of a firm during and at the end of an accounting period is often called the accounting cycle because it is repeated each year. You will become familiar with its important aspects as you study accounting. Accountants may take summer vacations like everyone, but if their organization's fiscal year ends on December 31st, January and even February can be months of hard work and overtime. The quicker the reports can be provided to management, the more useful they are. What is this periodically repeating schedule of accounting procedures called?